Welcome to Retirement Done Right with your hosts, David Rath and Pat Kalish, where we talk about retirement, Social Security, taxes, estate planning, wealth planning, and more. Now, onto the show.
The question that is on a lot of people's minds these days, especially if you are in the workforce, that is AI going to replace me and my job? Maybe not today, maybe 5-10 years down the road, but is it something I should be worried about? For today's episode, I took a very selfish approach to this and wondered, is AI going to replace my job specifically? And that is, as an investment manager for our clients, can somebody go to a chatbot and just ask, how should I allocate my investments? And then have a portfolio ready to go from there. So I want to bring on my co-host, Patrick Kalish. Pat, how's everything going?
It's going well. Good to be back with you, David. Excited for today's podcast.
Yeah, we did some solo episodes just to fill the time while we were reconfiguring things internally, but glad to have you back on. I think everybody appreciates the insights that you have. And so let's start talking about the experiment that I ran. And I wanted to see if I asked a bunch of different AI tools, what an ideal portfolio would be. What were the differences? What were the similarities? And first of all, I want to start talking about the tools that I used. So I used the four main ones. I did the Claude by Anthropic. I did ChatGPT. I did Gemini by Google. And I also did Grok. And I was kind of expecting maybe some weird responses from Grok because they have some humor and sarcasm built in there. But I think that the thing where I want to start with is I was kind of surprised that everything was pretty much the same across the board. Let me back up for 1 second, talk about the situation that I fed into the machines. And that was that retiree, 62 years old, over $1 million in assets, everything in taxable accounts, in tax deferred accounts, IRAs, or in tax free like a Roth IRA. So there was no tax implications to any of this stuff. I wanted to keep it as simple as possible. And so using that situation, gave it to all those four AI tools and said, give me a portfolio for a moderate investor, which we are. And then we go from there.
So let me ask you, right? Because I know like everyone talks about like prompts being very important when you kind of do these, when you actually talk or, work with AI models. So what was like the prompt that you used, or did you use hopefully the same prompt for like each of these models?
Yeah, same exact prompt. And it is kind of a skill. And most people learn that the better your prompts are, the better the output's going to be. I tried to be detailed enough where they would give me a response that was adequate for what I was looking for. But at the same time, I didn't get too complex in the situation. I didn't want to add taxes in. I didn't want to add retirement income distributions or other sources of income like Social Security. I didn't want that. Of course, that is part of our job. I wanted to keep it pretty simple to my job specifically. Again, very selfish in my endeavor here. Wanted to make sure that my job is going to be safe in the near term. But that prompt that I engineered was very basic and just gave the details of this and say, give me a retirement portfolio that my wife and I can live on. So that was the starting point. And then from there, the outputs that I received, most of them stayed in line with, I think, what most people would expect for a retired couple, between 50% stocks and 50% bonds, up to 60% stocks and 40% bonds. So pretty middle of the road, maybe a tinge on the conservative side.
Did you ask it anything about like risk parameters, or did it even push back to say like, what's the client's risk tolerance, so to speak?
I qualified myself as a moderate investor. So that is open to interpretation. And obviously, the amount of risk that one assumes in their retirement accounts and their investments is going to be very important. But all I said was moderate. I let them interpret that as they saw fit. So that can mean for different things for different people.
Yeah. First,
When we're having conversations with clients or prospects, we I like to say, are you a pedal to the metal type person or cash under the mattress or somewhere in between, right? Like kind of getting that scale set out from the outset where most of our clients, I would say, fall in that moderate category. And that is because, especially due to the fact that we have primarily retirees in our demographic, that people aren't looking to swing for the fences and hit a home run in their retirement years. It's more about downshifting, preserving some capital, and then obviously, you need to need to take some risk in order to generate any sort of returns. But we most people fall in that moderate category.
Yeah, and the only thing I'd add there too is like not to bash AI just yet, but like it's not going to be able to have really, I think, that conversation from a risk tolerance standpoint because we can ask some baseline questions to understand their risk tolerance, but a lot of I think our lead recommendation is based on how like they live their life up to that point. And it's understanding like context clues beyond just the questions that they're asking, that beyond just the questions we're asking to try and find a portfolio that's going to be appropriate for them. And I don't know if AI is going to be able to have that context to be able to provide, I would say, that lead recommendation.
What type of question do you ask, or do you have a favorite question to pin down the type of an investor that somebody is and the risk that they're comfortable with?
Yeah, I think it starts like from the top of a lot of times like we're already reviewing potentially an existing portfolio and better understanding like how they've managed the portfolio up to that front and then trying to pick like specific time frames of maybe moves that they made, right? Like what happened in 2020, right? What happened maybe in 2008 if you can remember so that you can really better understand their approach to risk management. And a lot of times, what I find, David, is that they didn't do a single thing, but that doesn't mean that they're an aggressive investor. They just didn't know what to do. And what I found too is a lot of people's risk tolerance really change when going from accumulating assets where they didn't really spend much time looking at their allocations to now having to take distributions come retirement and seeing that value drop is takes on a whole different meaning because you're starting to actually take money from that portfolio. So there's a lot that goes into it. And I think for us, right, it's a revolving conversation. This isn't a set it and forget it. All right, we're going to be a moderate risk tolerance for the rest of our life. Like we're continuing to check in to make sure that they feel comfortable in the plan that we built.
I love that, and I love asking people what they actually did during
Yeah.
times of stress. It's very easy to be a buy and hold long-term investor when the markets are going up. Everybody says
Oh
this
my
is
gosh.
easy, just making money year over year. My balance keeps going up. But when things start to go south, that's where the true colors are shown, and that's where it shows the true amount of risk that somebody is comfortable with. And that's why we have that as part of our official risk tolerance questionnaire that we send out before we open an account. The first step is that conversation with the client. The second step is the official questionnaire. And we ask, what did you actually do during COVID? Markets sold off over 35% in a few weeks. What did you do? And if you said, I actually saw that as a buying opportunity, you're get a check mark in the higher risk category. If you sold out and went to cash, chances are you're not comfortable with a lot of risk in your portfolio.
Yeah, for sure. So help us break down. So you gave us like a good understanding of the prompts that you used and the models that you used, but like what were the takeaways? Like what was the big reveal, so to speak?
Yeah, the biggest surprise for me was that everything was very similar across the board. I was expecting
Huh.
some variety in the different models and what they spit out. And coming from your former employer, where Pat used to work for Vanguard, there was definitely a Vanguard bias to the portfolios that were submitted and that were given to me. I would say two of the models were all Vanguard funds. Two
Wow.
of them were mostly Vanguard funds with maybe an iShares mixed in there.
Okay.
And so Vanguard's a great company. You know it well. They were the pioneers in index investing, in low cost investing. But I was a little surprised that they have the lion's share of the recommendations from AI tools. So the the biggest surprise for me was just how similar things were across the board, especially when it came to the fund manager that they were recommending.
That is interesting. So, I mean, yeah, it's good to hear that they're low cost. What about in terms of like the actual products that they were using? Was there like a specific like Vanguard fund or ETF that they were using? Like,
Yep, very broad-based indices. So total stock market index that covers the US market, international stocks for things of overseas. Two of them had emerging markets as a very small allocation in their portfolios. So
Hmm.
if I'm looking at this from my perspective, I'm curious what went into the back end of that would make some of those tools recommend a small sliver in emerging markets, and what would make the other tools not recommend it. And I think it's a good time to talk about just how AI works in general. It is not some being that is thinking actively. It's taking a very probabilistic approach to the questions that you're asking. So they are looking for, based on all of the information that they are being fed into those models, they're looking for the highest probability answer. And so I would say there's definitely some recency bias built into, especially the models that aren't recommending emerging markets. If we go back in history, the last 17 years have been terrible for emerging markets, especially relative to US stocks. But if you go before the global financial crisis started at the end of 2007, emerging markets were the place to be. They were compounding at multiple percentages year over year, and you couldn't get enough emerging markets in a portfolio because people were just they wanted to invest in the hot area of the world. So things go in cycles, and we recently added some emerging markets to our client portfolio based on our methodology research. But I would be surprised if moving forward things adjust in these outputs from AI tools. How quickly do they adjust? After 100% return in one of these investments, do they start recommending it after that move, or do they try to get in before it? I would guess more probably the latter than the former there.
So you're talking like broad-based textbook allocations across pretty much all four AI models with like slight variance that's like not really gonna change move the needle, kind of so to speak. Did it dive into it all like during periods of market stress? How would you manage this portfolio to make sure it maybe like stays aligned to this textbook allocation?
I didn't go that deep into it because I wanted just the first pass so we could
Yeah.
go into what my observations were from there. But I would guess, based on the prevailing thoughts out there in the financial world and what you see on most, as far as most recommendations for people, I would guess that if we saw a sell-off in the market and you went to your favorite AI tool and said that, hey, that portfolio that you recommended me, what do I do now? And I would be surprised if they said make changes. I would think that they would say stick to your guns, stick to the allocation that you have. And side note here, I wonder if there is going to be any sort of regulation of this stuff moving forward. In our industry, we have to be very careful about recommending things to people that are not necessarily under our umbrella and paying our management fees. So if we are seeing recommendations, like literal recommendations generated from these AI tools, is there any sort of pushback when things do go south? Like, let's say there's always a company behind these AI tools. And let's say somebody invests their money based on the recommendations of an AI tool, and then they lose a lot of money. Can you go after, let's say, OpenAI or Anthropic based on the recommendations that they gave? I don't know.
Yeah, and I think the interesting thing about this is like you gave it a decent prompt, right? But there wasn't really much to that prompt. It was moderate investor. You want a broad base allocation for being 62, and it spit out like it gave you literal recommendations that you could take and actually implement in your portfolio. And like at the end of the day, yeah, I mean, if the market's growing, people might be happy with it. But when the market sells off, like then what? Do you go back and does the AI tool even remember what it recommended you in the first place? Like, I don't know. That's pretty dicey. So I don't want to bash it though. Like any benefits, would you say, like that you saw from the AI portfolios?
Yeah, it's a good starting point. If you are not willing to go the route of having some paid professional do the work for you and manage your money, it's a good starting point, similar to if you took your money and put it into like a balanced allocation fund, that it's going to
Okay.
take the guesswork out of it. It's going to give you a diversified mix of stocks and bonds, and it's going to rebalance it for you. That's another side note. We didn't get into rebalancing it in my discussion with the tools, but How often do you rebalance? Is it once every year? Is it when it goes out of allocation tolerances? So there's other things that go into managing a portfolio rather than just that starting point. But if you are looking for the low cost approach, it's a good starting point because it gives you a portfolio, mostly, if not all, Vanguard funds, which are very inexpensive, and then that can be the outset. Where it doesn't necessarily hold water is in the adjustments that are made in the in the fear aspect when the markets sell off. I don't know how they would deal with that. I know that we take a proactive approach to managing risk internally, but I don't know how they would react. But I would guess probably they would say stick to stay the course.
Yeah. I think the other thing that I'd like to just ask you too is like very textbook allocation, but there's a lot of other value add strategies that can apply when you're thinking about creating a portfolio that actually have like really good academic research to back it up. So were you surprised that they didn't add any other type of value add strategies to like the overall allocation?
Surprised, maybe not. Disappointed a little bit because
Okay. It's a good way to put it.
you can add things that have been proven through rigorous academic research to add value to portfolios. And most people, when they think of diversification, it's holding a couple different stock and bond funds.
Yeah.
As we saw during 2022, things can start moving down together all at once. And that is something where throw the textbooks out the window. You have your nice correlation matrix and you're looking at what is lowly correlated to the other thing. And then everything starts going down together. And you're just like, what happened to the diversification? There's a great line, Brian Portnoy in the Geometry of Wealth. It's a book called The Geometry of Wealth. He said, he says, diversification is always there for the party, never there for the funeral. It's such a great way of putting it because on the way up, diversification, you're like, why don't I just invest in all the stuff that's moving in the same direction at once? But on the way down, as diversification starts to work against you and everything kind of starts to correlate during market stress, it's like, why was I diversified on the way up and now it's not working on the way down? And that's just kind of the way financial markets work. When there is especially panic and stress built into that current situation, you're watching everything be sold off. And so the way that we approach things internally is to be proactive about managing risk. It is about adding things like factor tilt, which are a way to capitalize on maybe some smaller, less expensive type stocks in the markets. Also adding multiple layers of not only diversification of the investments in themselves, but diversification of investment styles. So there's a lot of different ways that you can skin a cat when it comes to investing. You want, at least my opinion, you want to have exposure to all of them, or at least a good chunk of them, so that during times of stress, you don't want all your investments moving down together.
Yeah, absolutely. One more question for you. I'm just interested. So you gave it these prompts, it gave you the allocation. Did it ask you in any of the models, like any like follow-up questions? Did it try to go deeper into like who you were and what was like leading you to create this prompt?
Not really. AI, the way it's built, is always going to ask you like a follow-up question at the end, but it's
Yeah.
more along the lines of, would you like me to put this together for you? Like, would you like me to put this together in a nice visual spreadsheet for you? Or would you like me to add in some graphics that show the allocation? Not necessarily useful to people and that are looking for that. But to that point, our job as advisors is to ask those follow-up questions. And we're just talking about the investments today. We haven't even touched upon the coordination of your investments with every other aspect of your financial life. And I don't necessarily want this to be too much of a commercial for what we do, but it is a stark contrast to an AI model where they don't know a lot about you and your situation and the coordination of the other things that are a part of your financial life. I feel like that is where a human advisor would come into play.
See, and that's why I asked that question again. Like, no commercial, but like you need those follow-up questions. You need to understand like what life stage are you in? What tax bracket are you in? You know, making sure that you fully understand all the account types, making sure that you understand other income sources and such. Like all of that goes into, play when you're thinking about building, I would say, a reasonable allocation for somebody. And my other fear too is that, like, they gave you this good textbook allocation that it sounds like, could work, right? Long term. But like no one's actually checking in to make sure that even this is implemented, right? Like you could have the best allocation on paper, but are you actually following through and making sure that this is implemented as a part of your life? I think that's a big thing that AI can't do. And a lot of times, like, in our role, it's like, hey, we just have to hold people kind of accountable of like, hey, we had this discussion. I think this is going to be great for your long term success. Now, let's also make sure that this gets implemented. And I don't think any tool is going to be able to do that.
And these things are always evolving. They are
Right.
coming out and being much more close to a world where maybe they have some sort of actual intelligence built into them. I don't know. I'm not smart enough to predict that kind of stuff. But as it stands right now, it is very it is very rudimentary as far as the ability for it to look at your personal situation and again, now we're back to that make recommendations uh, challenge. When if they're making recommendations, I would assume that they would know a lot about you to make those recommendations. We built this prompt task off of just a very simple situation, but of
Yeah.
course, every person's life is going to be different, and investment management is one piece of what we do. Financial planning, tax planning, distribution planning, coordination with Social Security, Medicare, et cetera. All of that is going to be built into the process of working with a human advisor.
Yeah. Well, I appreciate you doing this though, putting your job on the line and saying, let's see if AI can, whip up a portfolio. And I know it doesn't look like a David Rath portfolio. So
Yeah, it definitely doesn't look like what we have internally, and I think that's by design. There was an old line in business where you never got fired for hiring IBM. IBM was the preeminent technology provider back in the day, and you would never get fired for bringing in an IBM infrastructure into your business. And similar to that is the AI tool isn't going to quote unquote get fired for recommending a 60/40 portfolio
yeah.
of Vanguard ETFs. Like it's the most down the middle, straight shooting thing that you can do. So it is what it is. And as I said, it's a good starting point. The other thing that I want to touch on before we sign off here is the propensity for AI tools to be incorrect. And there's a lot of studies out there. I just read one recently that in multi-step investment processes, like if you are trying to take the allocation that the prompt gave you and run that through some tests or ask follow-up questions, and now you have multi-layered prompts built into it, the propensity for the AI tools to be incorrect. This study that I read had it 85% of the time was incorrect. And I'll just tell a quick anecdote about this from my own experiences. And that is I was looking for some quotes for the monthly newsletter that I write. And so I asked for some quotes that would relate to the subject matter. And it gave me 5 quotes. And I said, okay, first one sounds good. Can you just verify the source on that quote? And it got back to me and said, actually, good question. That is an incorrect source that I first listed. I'm like, okay, if
Yeah.
I didn't ask, then I would have, I mean, not the end of the world, me misquoting somebody, but it is not the first response that I got because again, they're aggregating all the data that's out there, coming up with the best available quote or the best available solution. So now I'm in a situation, it's like, I got to do the research on my own to figure out who actually said this quote. And then it happened again. There was another quote in there. I was like, that's surprising. I didn't know that that is who said that quote. And it said, you're right again. That quote was also misattributed. So something as simple as asking for a quote does need to be verified by somebody who knows what they're talking about, or at least is asking the right questions. So if that is the experience with those types of tasks, I use AI as a thought partner, a idea generator.
Yeah.
I think it's great for those types of things. You can do deeper research and uncover things that you never even knew about and going down rabbit holes. Like that's what I love doing with it, is going down rabbit holes with it. But if you're asking it to replace some sort of job, I'd say be very careful with that because it is fraught with errors at the moment and this is your life savings in the line. And do you want to trust something that doesn't necessarily live and breathe.
I mean, as simple as a quote, it got wrong. When you think about what, maybe some people are asking these things to do, like, hey, come up with a Roth conversion strategy. Oh, whoops, you got blown into, the next IRMA surcharge on Medicare. Like, that's a
Yeah.
big deal, so you got to be so careful. Good, really.
I would be really curious to see how this evolves, and is there going to be some blowback for that exact example which you just gave? Give me a strategy that helps me save on taxes. Oh, guess what? They just recommended it. They just recommended something that is actually not technically legal in the tax code. And are you willing to trust a computer or a computer program to make those recommendations for you?
Yeah, and I think you brought up a good point. It's a thinking partner, like it, and use it as such, but always verify, the information that you're gleaning from it, and work with people that you trust that have the designation that's going to be able to provide the right information for sure.
Yeah. Long story short, the robots haven't won yet. We're still here. Check back with us next year. We'll see if we're replaced by some Terminator bot.
Sounds good.
All right, signing off. We'll see you guys next time.
Awesome. Thanks, David. See ya.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.